two notes. For anyone that wants to communicate with me for questions or with the entire room, you can use the key down at the bottom, the little chat area, and you can select who you want to speak with. You can go directly to Rick if you'd like. The other thing I just want to call your attention to is, unfortunately, we're having a little technical difficulty, and before the end of this, I do want to give Rick's contact information so members of the audience have it. But as I said, we have a lot of territory to cover, so let's begin. And I think a good place to start, Rick, is give us a quick and concrete definition of artificial intelligence, otherwise known as AI, and what is meant by machine learning. So we have two definitions here to kick this off.
Sure. Bob, the definition of artificial intelligence is not that rigorous. Rather, it's very, very broad. But artificial intelligence is a branch of computer science really concerned with making machines behave like humans, giving them the capacity to play games, see, understand, talk, and learn. AI is meant to mimic or perform tasks that require human intelligence, like image recognition or natural language processing and comprehension. We'll talk about later today. Language translation, robotics, planning, and automatic reasoning. The field of AI is the broad topic, and machine learning is a subset thereof. To try to demystify machine learning, it really is a catch-all name for a wide range of applied practical algorithms. Machine learning refers to the ability of computer software to improve its performance by exposure to data without the need to follow explicitly programmed instructions. Certain types of machine learning techniques they've been more powered more recently in the most recent decades by graphics processing units, and you can access a number of these machine learning algorithms through computing and use open libraries. But what machine learning does best, it detects patterns and can make predictions and improve over time. That's why it's called learning itself. An example would be going from, let's say, 59% accuracy in image recognition to the mid to high 70s and so on. You know, machine learning algorithms like convolutional neural networks have achieved image recognition accuracy better or comparable to humans. And really, when you look at it, it's an intersection of computer science, statistics, probability. It's really based on doing ridiculous amounts of multiplication problems very fast. Final point on machine learning. It really excels at making predictions, Bob. Candidly, in most domains, algorithms are superior to humans at making judgments and predictions across the board. But I believe that it's so relevant for asset management because what do we do in the asset management industry? We make predictions every day. You know, some of you on this call every minute into the direction of market. That's why I think it has the potential to be so disruptive.
So Rick, could we say that machine learning is akin to thinking, or is it at that level?
Well, it does not have. I don't think it has obviously the same capabilities, and we'll drill down a little bit later on in terms of deep neural networks and the kinds of results you can get by mimicking the human brain. So is it at the level of human thinking today? No, but I will tell you that there are certain advantages to machine learning in terms of pattern recognition and clearly the brute force of computational power to process much more data than Homo sapiens is capable of doing. And so, again, with the absolute deluge of data, I think machine learning is a very important tool that can be used by successful asset managers.
So in a sense, it's a labor-saving device, right? It frees us up from calculating.
Yeah, in fact, it can. Not only does it do automation, obviously at much greater scale than humans, Bob, and one of the things that they found with machine learning algorithms, I don't want to go too much in the weeds here, is that they are more adept at pattern recognition than many humans are. And again, humans were logically evolved to see patterns even where there aren't any. But one of the problems with machine learning down the road is going to be there's something called XAI, explainable artificial intelligence, where some of these algorithms and the superpowers or supercomputers used to power these algorithms produce results that are very difficult to explain as to why or how they arrived at that conclusion.
Okay, very interesting. So can you give some examples of where, let's say, machine learning can outwit, let's say, the master in a particular game domain?
In fact, what you do, you lead to a very interesting question. You know, machine learning was pioneered to play games. The guy who coined the term machine learning, his name was Arthur Samuel. What he did was he programmed his computer to beat him in checkers, and subsequently in 1962, Samuel's computer program beat the Connecticut state champ. Then it was used most prominently, and everybody in this call will remember this at least somewhat, in May of 1997. IBM's Deep Blue 2 outlasted Garry Kasparov. Now, Kasparov held the record for the longest time as the #1 rated player, and at age 22 was the youngest world chess champion in the world. In his book, Deep Thinking, I'd really recommend Deep Thinking by Garry Kasparov, he tells his side of the story, how he felt losing to IBM's machine. Now, he won game 1, but he resigned in game 2, and if game 2 had continued in the 6-game match, it resulted in a draw. You know, this was, according to Kasparov, one of the worst blunders of his career. And again, in his own words, what Kasparov said, he was demoralized. I'll circle back to this topic later on, because one of the advantages of machine learning is to try to mitigate human biases and to deal with the kinds of human emotions that we have, because Kasparov, again, in his own words, said that he really after game 2 was demoralized and could not get his mojo back, and that's why IBM beat him in game 6, where he quit after only about an hour and 19 moves. Two other applications of machine learning where it's been used: the Jeopardy champ Ken Jennings, who had won 70 games in a row, and Brad Reuter. Brad Reuter, his name may not be familiar to you all, but he's won more game show money than anybody on the planet. Well, IBM's Watson machine, not their Deep Blue, but their Watson machine, beat both of them handily by using natural language processing of training data from Wikipedia. Basically what they did is they used natural language processing, that is machine learning algorithms, to train the models on everything in Wikipedia. But here's another very important element as well. The IBM's Watson machine was much quicker hitting the buzzer speed. And in fact, in the Jeopardy sections, in 24 of the 30 questions, Watson buzzed in quicker than either Jennings or Reuter. So even though Jennings and Reuter may well have known the answer to those questions, the machine's capability, its speed, was able to beat them to the gun. Again, one of the things I think in terms of the applications and the necessity of exploring machine learning today is the speed of financial markets and the speed of transactions. High-frequency traders today can do trades in 10 milliseconds. That's 10 one-thousandths of a second. 10 1/millionths of a second, I'm sorry. And so I think machine learning is, by necessity, is going to have to be used more and more.
And the frames that you described are imperceptible to human beings.
Exactly. You know what? It takes us 300 to 400 milliseconds to blink our eyes. If you look at the time limit, the latency of high-frequency traders, they could conceivably do 30 to 40,000 trades, and the time it takes us to blink our eyes.
So I think, as you're inferring, machine learning has been around for several decades, right? So
yes.
I think you're also suggesting that there are certain types of techniques that machines are superior to performing over humans. So how would you classify these machine learning techniques? Could you put them into categories for us?
Sure. You know what? One of the things I'm going to use as a reference, a classification system done by J.P. Morgan. J.P. Morgan, I would urge you all to reach out and get this. You can probably find it online. They published a report in May of 2017 called Big Data and AI Strategies. And what I like about the quant group at Morgan Stanley, what they did was they classified machine learning algorithms into 3 categories for the purposes of investment management. Those 3 categories are supervised learning, unsupervised learning, and deep learning. In a moment, if you want me to delve down a little in the weeds, a little detail in terms of giving
high level, sure.
Supervised learning, it's been around for decades. It's been used by the Postal Service. In supervised learning, that's designed to start with a labeled data set to train a model by using one or several of dozens of machine learning algorithms. There are dozens and dozens of machine learning algorithms because they've been around since the late 1950s. It's called supervised or structured learning because your training data is labeled. It's sort of like a student that learns a subject by studying a set of questions and their corresponding answers. And ideally, you end up with a model that's accurate enough at predicting labels of new data that's run through yours. In supervised learning and in asset management, what you do is you're trying to find a rule or equation that can be used to predict a variable. For instance, we want to look at momentum or trend following signal and find the one that has the best likelihood of predicting future market performance. Again, that's supervised learning. What about unsupervised learning? Bob, most of the data in the world is unsupervised or unstructured. When I say most, somewhere between 85 to 90 and 95% of all the data in the world is not labeled. It's unsupervised or unstructured. What we're doing with unsupervised learning is trying to uncover a structure in the data. In unsupervised learning, basically what you're trying to do is you're using text. You could use audio and video files. The text you could use. So you could use social media sentiment. You could use blogs. You could use SEC filings. You could use data from corporations' business processes. You could
what about images?
Yep.
What about images?
Satellite images, GPS, smartphones, all those would be included. They're all categorized in the unsupervised learning. Basically what you're doing, Bob, is you're using these advanced algorithms that do not have to be explicitly programmed to try to find patterns and make predictions. Deep learning.
Isn't that the essence of thought, though?
Yes, and again, I said that when I and in a moment I'll go into deep learning. Deep learning is really inspired by biology. Does that mean machine learning algos have the same capabilities as humans? No, not at all. In terms of our ability to be creative and to add domain expertise. But when you look at the third area, the third category, Bob, deep learning. Deep learning's been around for decades as well. Deep learning, you're using these models, and they're called either artificial neural networks, ANNs, or deep neural networks, DNNs. And they're used as well, image recognition, voice synthesis, natural language processing. They've used to beat games like Go. Go's have been around for 2,500 years.
Yes.
They've been in chess. But they can also be used, most importantly for our audience today, to learn predictive patterns in financial data sets. That's why we want to use them. And they're called deep learning because they have multiple layers. For instance, a deep learning model, the most simple one, has at least 3 layers. It has an input layer, it has a hidden layer, and it has an output layer. So the input, obviously, is your data you're putting into your model. And the hidden layer, that's where all the calculations, the millions or hundred thousands or billions of calculations take place to really use statistics and probability to try to predict what it is. And then finally, you have your output layer. But I know of models today, learning models, that have over 1,000 or over 1,500 different layers. Now, those deep learning models are also powered by supercomputers. You have to have them. And again, you don't have to go buy a supercomputer. You can access them through AWS, Amazon Web Services, through Google, through Microsoft, through other vendors. But they're very, very powerful algorithms in terms of their ability to make predictions and to improve over time. Again, that's why it's called machine learning.
Okay. So when you and I spoke offline, we talked about how essential regression is, the concept of regression and the practice of regression is to predicting the future. And we talked a little bit about ML-powered regression. What is ML-powered regression, and how does it apply to investment management?
You know, as a communicator speaking about this topic, what I try to do is I try to make things simple enough for me to understand so I can communicate to a layperson audience, if you will. And when I look at, I was curious about not only the categories of machine learning algos, right, supervised learning, unsupervised learning, deep learning. Again, you could go and have other categories such as reinforcement learning. I won't go into that now. But I was really curious about, okay, well, what do these algorithms do? What kind of tasks that we as humans do, what do they try to accomplish? And basically, there are 3 categories, one of which you already mentioned, regression. One category, one task that these algos perform is classification or classifier networks. Here, I'll give you an example in the investment space. In a classifier network, I'm basically trying to make a binary decision. I'm trying to find stocks that are going to go up or down. Again, binary decision. If they're going to go up, I'm going to go long that position. If they're going down, I'm going to short the stock. Regression's been around for hundreds of years. But when you're using machine learning to accomplish regression, again, you have much more brute power, computational force. But basically what you're doing with regression, Bob, you're trying to find a numeric value. So I might here be trying to find stocks that are going to go up 1% or stocks that are going to go down 1%. So again, it's taking a common and developed technique, that is regression, and putting it on higher octane by running it through machine learning algos.
Which is why it's viewed as being so disruptive.
Yes, and in fact, you know what? Digress too much, but I believe, and I was going to say this from the get-go, that we're far too complacent for comfort in the industry. And when I say that, I already know that asset managers have been looked at by PwC and surveyed among 13 industries, and it is the laggard industry of all 13 industries that were surveyed by PwC in terms of using machine learning for decision making. Literally, it ranked dead last. I also know that folks like Robert Capito, the co-founder of BlackRock, said, you know, Apple was not in the music industry, Google was not in the mobile phone industry, Amazon was not in groceries until they were. I believe that some of these digital dragons, these firms like Amazon and Google and Microsoft, have the ability to be very disruptive forces in investment management because, and again, you and I chatted about this offline, Gemini does a World Wealth Report every year, and their 2018 report, they surveyed 2,500 worth investors worldwide, and just looking at a subset of North American folks, found that 81% of these high net worth investors, this is the question they asked. They said, how soon would you be willing to begin a wealth management relationship with a large tech firm such as Google, Apple, Facebook, Amazon, Alibaba, or Tencent? 80% of North American investors, high net worth investors surveyed, said they'd be willing to consider within 1 to 12 months. So again, back to the complacency issue, these models have the potential, if used by big tech firms, to be very, very disruptive to asset management. That's why I believe that asset managers have to get on board with this revolution.
So Rick, you bring up some really important points, which leads me to ask you this. To what extent is machine learning currently being employed in the investment process? And can you give us some examples? I mean, I know, I think you mentioned Bridgewater. Maybe in a moment after you tell us where it is right now, we could talk about some of the firms that are currently employing this technique.
Sure. I'll tell you where it's mostly used today in investment management. It's used in trade execution. And I say that, according to J.P. Morgan and others, roughly 95% of U.S. equity trading is done via algorithmic trading. Now, some of them may have been algos that were developed like TWAP, VWAP, volume-weighted average price, time-weighted average price that were developed decades ago. But more and more, the algos that are being used for trade execution are machine learning algos, and they have names like Sniper and Gorilla. What they do is they slice and dice orders to try to disguise, who's buying and selling what. When you look at additional applications of machine learning in investment management, Bob, basically there are three kinds of areas where it could come to play in securities analysis, research, and investment management. Number one is data gathering, finding, scraping, cleaning, and structuring data for use in the modeling process. That's number one area outside of trade execution, I'm talking generally. Secondly, in investment decision-making, basically seeking alpha. You could use other investment data, I'll talk about in a bit, find statistical relationships and create models to trade based upon those relationships. And then finally, in portfolio construction, optimizer, and risk management models. There's an interesting academic paper I read recently. I won't mention the name of the author. He is a New Yorker. I don't know if he's a member of the New York Era, but he is using an advanced reinforcement learning model, He's by training, he's a PhD in computer science, and he's a money manager. He's using a reinforcement model for portfolio optimizer for sizing. So again, mostly used today. If you said to me, Rick, where are these algos having the biggest impact? Trade execution today. It's not a differentiator. What I look for people that are using machine learning in end-to-end portfolio management. They're using it in alpha seeking. They're using it for their position sizing or the bets they're taking. They're using it in their risk management models. And oh, by the way, they're using it in trade execution.
And who are some examples that you might be share with us?
I call this the revenge of the nerds. I'll give you a couple here. Probably one of the most prominent and earliest users.
Hey, Rick, hold on one second. Rick, hold on one second. I'm sorry. Someone in the audience. There's some noise coming from the audience. If you could shut that down, we'd appreciate it.
Getting their people to work on our staff, we work on their staff.
Hello.
Is there a way
Someone in the audience, please put your phone on mute. Please put your phone on mute.
Yeah.
Rick.
No problem at all. One of the oldest practitioners is Renaissance Technology, Rentech, founded in 1982. They manage $130 billion. They were founded by Jim Simon. Jim Simon has a PhD in math, and he was a national security agent code breaker. What they do is they're using cryptology. They hired cryptologists, that is code breakers. They're using hidden Markov models. They use maybe hundreds of different alternative investment data. Now, one of the reasons I point out to them is that now Rentech has 4 funds. Their showcase fund or flagship fund is the Medallion Fund. It founded in 1988. That particular fund, if you invested $1,000 in it in 1988 when it was founded through 2016, the last year in which I had numbers, your $1,000 was worth $13.8 million. Now I'll tell you how, and one of the caveats that I'll explain. All the information I'm using is basically publicly available. It's from SEC filings. It's by reading extensively academic papers. I've read 15 or so academic papers by principals that now work at Rentech. People like Pete Brown, Bob Mercer, and the like. And what they've done is they really were a pioneer in using speech recognition and speech translation to try to find signal in the investment market. Now, this pioneer I'll talk about is David E. Shaw, and the D.E. Shaw Group, or D. Shaw and Company. Now, David Shaw himself has a PhD in computer science from Stanford. 1986, basically, according to a book, The Quants, he had a falling out with his manager at Morgan Stanley, left, set up shop over a communist bookstore in the Village, and really used statistical arbitrage. He drew on the work of a guy named Edward Thorpe. Now, Shaw himself is infamous for his penchant for secrecy. They managed, as of July of last year, they managed $50 billion in investment capital, and they have 250 technologists. What Shaw says is their goal is to look at the intersection of computers and capital and find as many interesting and profitable things that they can do in that space. When I look at these firms as pioneers, I look at both the practices that I've been able to uncover through my research, but I also look at the kinds of hires that they've made. And one of the most significant hires was by Bridgewater Associates. Bridgewater Associates, a number of years ago, hired this guy, David Ferrucci. Ferrucci's a PhD. He was senior technologist and led the team at IBM. It was called the Deep QA project. Deep QA is Watson. I led the 30 artificial intelligence researchers that beat those Jeopardy players that I mentioned earlier. Now, Bridgewater, they have $163 billion as of their most recent filing under management. And Ray Dalio, if any in the audience have read his book Principles, and maybe many folks have, you would know that Ray Dalio is obsessed with cognitive biases and using algorithms. He believes algorithms can really improve the investment process. So again, why do I put Bridgewater in this category? I put them in this category both because I know of Ray Dalio's passion for using algorithms in the investment management process, but also for a very, very significant hire that he made to build out his team. The other example I'll give you is Two Sigma. Now, Two Sigma is a $78 billion shop founded in 2001 by David Siegel, who has a PhD in computer science from MIT, and the co-founder, John Overdeck. Overdeck has a master's in stats from Stanford. They both used to work at D.E. Shaw, along with Jeff Bezos. Now, at Two Sigma today, they have roughly, according to their filings, 1,100 employees, two-thirds of which are involved in research and development. And basically, again, according to their own representations, they're harnessing data from thousands of different sources. Now, again, I went back and said, what do I look at? I look at what I've been able to find research-wise of these pioneers and early adapters in terms of their processes, having read their brochures, their Form ADVs, on the SEC. Again, I look at their hires, and Two Sigma did was last year they hired Mike Schuster. Mike Schuster worked at Google as a senior scientist for 12 years. What Two Sigma and others do, Bob, they will hackathons to try to hire people. They will do these contests. We're paying prize money to programmers to try to see the kind of talent out in the marketplace. I'll talk a little bit later at the end of this presentation about steps for those companies who want to be most advanced. That's something that they might want to consider in terms of when it comes to hiring practices.
Rick, before we shift gears and talk about alternative investment data, I want to ask you one question I think belongs here, which is, what exactly is Quantamental?
Quantamental is a combination of fundamental analysis, which has been around for hundreds of years, and integrating more and more quantitative analysis along with that. Now, there are certain shops, big shops like BlackRock, that are migrating towards a Quantamental model. When I say that, now, BlackRock is the world's largest asset manager. The last I looked, they had like $6.3 trillion of AUM. It may be higher now, but the last that I looked anyway. They opened up a shop in Palo Alto back in the first quarter of last year called the AI Artificial Intelligence Lab. So what they're realizing, like many asset managers are, they've trouble across the board, many asset managers, keep up with their benchmarks. There's been lots of pressure for fee compression. So firms like BlackRock, who have a history of both a strong fundamental research and analysis, are integrating more and more data into their process and are using machine learning. Now, another example, PIMCO. PIMCO, the world's third largest fixed income manager, they had, as of last year, only 2 offices in the United States, Newport Beach, California, and New York. They opened up a third office in Austin, Texas. Why did they do that? They opened in Austin, Texas because of the tech community there. There's a very, very strong tech community, and in their statements, that is in PIMCO's public announcements, they indicated that they're going to look to hire some 200 folks in that area who have a background in data science and machine learning algorithms so that PIMCO, can do a better job at predicting inflation, which obviously has a very corrosive impact on fixed income securities, and to bring to market other fixed income strategies at PIMCO that might be cheaper, if you will, less expensive, because they're primarily using chief investment algorithms instead of chief investment officers.
Okay, so before I ask you for a concrete definition of alternative investment data, I just want to ask, there's someone in the room from Venkat. Please put your phone on mute. Phone on mute. Rick, go ahead. Give us a pithy definition here of alternative investment data, please.
Sure. Probably one of the easiest ways to do that, Bob, is give what traditional investment research does. Traditional investment research, again, all the folks on the phone already know this. It uses historical price, history, tick data, earning estimates and revisions, fundamental data from corporate income statements and balance sheets, macroeconomic indicators like interest rates, Fed policy, other central bank policies, market breadth, depth, liquidity. alternative investment data is non-traditional. It's really using some of the kinds of information I talked about earlier of corporate filing. Sometimes what it's called digital exhaust. Digital exhaust could be corporate record keeping. It could be banking records. It could be supermarket scan data. It could be emails. It could be either employee, past and present employee, comments about the company. It could be jobs hiring data at firms. It could be customer satisfaction surveys. Basically and again, you talked earlier about satellite images. I'll give an example of alternative investment data. Today, in the petroleum industry, with satellite images, you can tell how much oil is stored in a land-based facility based on the shadow that the lid of the storage facility cast. In my mind is mind-boggling, but equally mind-boggling. And when it comes to the petroleum industry, you can also use satellite images to find ships in the ocean and determine how much petroleum or natural gas they have in it based on how low that ship's hull is in the water. So today, imagine you're a petroleum analyst, right, or a PM that specializes in the energy industry.
Sure.
You can use these satellite images to augment fundamental. That is basically to be a quantamental. You're augmenting your fundamental analysis on these companies with quantitative data that previously was unavailable, because today we have roughly 1,500 satellites or so circling the planet, taking pictures all the time. If you're a commodity trader, you could look at weather patterns. If you were a retail analyst, you could look at images of parking lots and find one of the problems with Sears that they didn't have enough in those parking lots at Sears malls. Or you could use smartphones. Today, folks are selling this kind of data based on traffic when you go into a store. If I have my GPS enabled on my smartphone, they may know that I went into a Gap store or a Banana Republic or whatever based on me enabling my GPS or not disabling as I walked into that store. So when I use the example of alternative investment data, it's 1% of the world's data is currently analyzed. And I believe that more and more asset managers will be forced to look at alternative investment data as a part of their overall investment processes.
So, Rick, it almost sounds like going forward, or maybe already now, if you don't have this perspective and the tools at hand, you are at a significant competitive disadvantage.
I absolutely agree.
Not only in investment management, but in other fields. So if that's the case, how can those in the audience take steps or begin to use AI and machine learning in the portfolio management world?
Let me put this first. One of the strategies they could use, and again, you don't have to develop this on your own. You can source it through vendors. You could use natural language processing, NLP. Why would you want to consider doing that? Hey, Bob, a recent BlackRock report called Finding Big Alpha and Big Data.
What is natural language processing?
Right? Natural language processing has been around since the 1940s. It's a way in which you're trying to understand what either the spoken language or text is. You're using machines to do that. Bob, on my desk, I have a report here from MIT that was written in September 1st, 1967. You know what it indicates there? It indicates that machine-readable text and machine-readable data was widely available in 1967. So basically, what you can do is you can use text provided. In fact, I won't mention, but one of your sponsors I know has a product, obviously, that's machine readable. Maybe multiple ones of your sponsors do. Basically, what you do is you run that through using your algorithms, and you may or may not be using a supercomputer for this, and you decipher sentiment. And I say decipher sentiment. You find whether the sentiment for stock is positive, neutral, or negative. Again, if it's positive, you go long. If it's negative, you go short. So natural language processing has been for decades. Again, this report is 52 years old, showing machine-readable texts. But I can tell you today, in terms of the laggards in the industry, to my knowledge, very, very few asset managers in the aggregate have incorporated natural language processing. Now, I will add as well, some of the areas may be overexploited. I'm actually somewhat pessimistic about the value of sentiment that comes from Twitter. And the reason is I myself know of a dozen or 15 vendors right now that are plumbing that market and selling data based on sentiment, and it's not in any way throw them under the bus.
Well, Rick, if I may, just go back to the comment you made earlier about NLP. If one of our sponsors is involved in this, I'm sure they wouldn't mind if you mentioned their name, and maybe those in the audience would also be interested to know who they are, if comfortable doing that.
Bloomberg provides machine readable text and has for I'm sure for decades. And
good
so,
to know. Thank you.
Yeah. Let me give you and the audience some suggestions in terms of where you might turn to. And one thing I said earlier, how I came upon this information was reading literally hundreds of academic reports, reading the SEC filings, reading trade books, reading books on machine learning, reading books like Advances in Financial Machine Learning. But it's important for me to note I have no commercial ties with any of these firms that I'm mentioning, none, nor Little Harbor. But some of the ones that I personally have met with or either go to their programs or receive their information, Lucena Research in Atlanta, Georgia. Ravenpack is based in Spain. Ravenpack's been around, 9-10 years providing alternative investment data. Eagle Alpha is a UK-based firm, but they have an office in New York. A website that people could go to, alternativedata.com. Another website, bananadata.com. The firm in Toronto, Quando. So here's what I'd recommend. If you don't have that J.P. Morgan report from May of 2017, Big Data AI Strategies, either contact Bob. I'll make it available to the New York area. I don't think that they would mind me doing that because you can find it online today.
Let me just let's call everyone's attention to the screen. Contact information is at the bottom of the screen there. You see his cell phone number, the 612 number, and you can also see his email directly below that. And Rick, I am sure, would be happy to speak with anyone in the audience. So I'm sorry,
Absolutely.
Rick, please continue.
Well, here I'm directing. Now, the J.P. Morgan report is 280 pages. So people might say, "Oh, geez, I don't have time to read it. Maybe I need natural language processing to read that report."
Right.
But here's what half of it is: a directory of over 500 firms that provide alternative investment data. So, and again, don't take Rick Roach's word on it. Go to some of these sources. You can sign up for information from some of the websites that I just mentioned, or read that report. Looking at so that you're a manager in a certain space and you're looking for satellite images, you will find a listing, not an entire directory. It has like 500 names. There are probably 600 to 1,000 alternative investment data providers worldwide today. That industry estimated that alternative investment data research firms spent somewhere between $400 million and $650 million last year in 2018. So again, that is not a full comprehensive directory. If I publish a directory in 2017 in this space, I'm going to have to update it obviously, yearly, probably quarterly, because there are so many new entrants, Bob, that are coming in. But that's one of the ways in which I think that people can get started is to access some of this alternative investment data to try to see whether or not it's consistent with their investment strategy.
So Rick, in our closing time here, because I have a bunch of questions that have come in from the audience, I do want to ask you one last question, and that question is, will machines take over Wall Street and investment management? Are analysts and portfolio managers doomed by all this? What say you?
I don't think so. I'm partial to humans. I believe that domain expertise will still be valued, even given computer powers. Here's an example to put something in context. Deep Blue in 1997 did 200 million calculations per second. To me, that sounds like a lot, right? The supercomputer purchased from IBM by DOE, Department of Energy, last year, just 200 quadrillion calculations per second. That's a billion times faster than IBM's Deep Blue. But personally, I think that's unlikely. You know why? Because capital markets are an order of magnitude more complex and statistical noisier than many of the areas so far where machine learning has reported greatest success, like in games.
Okay.
Games, chess, Go, whatever. There's a series of rules, right? In the investment world, there are very, very few rules. You have fear, we have greed, we have risk on, we have risk off, we have contagion. So we have the widespread occurrence of fat tails. I believe that trying to navigate this path, the best option going forward is to use augmented intelligence. You said earlier, one of the advantages of these machines is to automate decision making, to read the thousands or millions of pages of reports, to decipher and find sentiment from that, to have the machines help you, but then for the asset managers, for the analysts and the like, to apply their domain expertise, their judgment to that data to make portfolio decisions. So no, I don't think we're doomed.
Okay. So on that note, let me pose a couple of questions here from the audience. And the first question that we got from the audience is, in your view, Rick, what major sector in financial services so far has been most disrupted by AI and machine learning?
I think that there are 5 major sectors: asset management and securities analysis, Bob, banking and payments, insurance, financial advice, and securities brokerage. I would say the payments industry and securities trading have been most impacted so far.
So in a sense, the ones that are least complex, you could say.
Yes. Yeah. And in fact, if we had draw examples, the payments industry too, credit card companies have very, very advanced fraud detection, right? So they've been using machine learning for decades. And so the payments industry, I would say, and I mentioned earlier, 95% of all securities equity trades in the U.S. is through algos. Many of those are machine learning algos. The same is true with managed futures contracts. Most managed futures contracts are done through algos.
So peer into your crystal ball there, right? Because they said everyone in this business is about predicting the future. Looking out over the next, let's say, 3 to 5 years, what sectors within financial services do you see being most disrupted in that time frame?
Asset management. Someone would say, well, why, Rick? It's because I know from PwC, PricewaterhouseCoopers research that the asset management industry is the biggest laggards right now in terms of using machine learning for decision making. So if you look at sectors of finance that are most ripe for disruption, and you look at investors' confidence with big tech firms like Amazon or Google or Microsoft, I think asset management is the area that will be most disrupted over the next 3 to 5 years, the immediate term.
Now, obviously, you've been a very serious student of this whole process, and you've watched it very closely. And you pointed out earlier that a lot of this has been available. A lot of these capabilities have been available for several decades. So, given all that, what would you say your biggest disappointment has been so far with machine learning-powered investment strategies?
I think the lack of available retail investment products that are using end-to-end. And when I say that, all those firms I mentioned earlier about are hedge funds, large hedge funds, the minimum investments of $1, $5, maybe $10 million. We've not had this trickle down yet, if you will, to investors. So I think the lack of available retail investment products powered by machine learning, it would be my disappointment so far.
And you earlier weighed in on your view of the value of sentiment being emitted or conveyed by Twitter. What do you think about some of these other social networks in terms of the value of the sentiment that they convey? Any thought on that? I
think that natural language processing can be very, very valuable in terms of investor sentiment. Now, I just gave one example, a limited one, if you will, of Twitter, but there are other social media platforms. There are thousands or tens of thousands of SEC filings. You could use machine learning to track events. You could use machine learning to read all the articles that are published in Dow Jones News service. In fact, one of the companies that I mentioned earlier, RavenPack, has a service that does just that. And they report to you within 400 milliseconds the sentiment. They basically score it as positive, neutral, or negative. So I believe that NLP's potential for sentiment scoring is terrific. Earnings announcements, earnings revisions, all those kinds of areas. I just believe that in certain social media platforms, because there are so many competitors, if you will, it might arbitrage away the potential alpha that you'd find otherwise. But I believe it has terrific, terrific potential.
Okay. And what would you say the biggest drawback of the machine learning revolution has been thus far?
The privacy. It is very, very invasive machine learning in terms of the privacy, and not only things from Cambridge Analytica, but most of us have our GPS devices enabled all the time on our smartphones, and so someone, Google or whomever, or Verizon, know exactly where you are. So
is this irreparable?
I don't know. When I say that here. What they did in Europe, Europe passed and it went into effect the General Data Protection Regulation, GDPR. I don't know that the United States Congress would pass something like that. Again, drawing on my decades and decades ago state legislative experience, there are states that have looked at putting in place some privacy regulations. I don't see it happening on a national level. But I would say that what people should be mindful of is be mindful of when you're allowing these sites to track you, that if you have privacy concerns, disable that or tell them no, they can't. So again, in Europe, they've done that for the European Union countries, but we don't have anything comparable to the General Data Protection Regulation here in the States.
And what do you think the biggest risk that AI and machine learning poses for capital markets in general?
I don't worry about like a Terminator, or I don't worry about, and again, can machine learning exacerbate volatility during market turbulence period? Yes, I would think we'd be naive to think that it can't. But honestly, my biggest concern is the ability of regulators to keep pace with the market velocity and with better AI resource firms. I don't know that the SEC, FINRA, and the other regulators, and I'm just talking about the states here, but it's globally as well, have the capability to keep up with high-frequency traders and or to detect in advance, fraudulent insider trading, hopefully through that exhaust, right through the exhaust created by the trading, they'd be able to track them down. But my concern is the ability of regulators to keep pace both with the speed of markets and the better resourced artificial intelligence research firms.
And here's a question which is a little more general in scope. Over the long term, what industry do you see as being most disrupted by the machine learning revolution? Healthcare.
And you know what? When I say that early diagnosis, treatment, and prevention of disease, I'm actually hopeful that the healthcare industry will be the leader in terms of its ability to provide early detection, novel treatments like harnessing the body's immunological system, and ideally to prevent the onset of disease.
Makes sense. Let's go back to the risk side of the ledger here. What do you think the biggest risk of AI machine learning for society? How would you characterize that?
I read actually about an 85-page report by a group gathered at Oxford University in terms of the kinds of malicious uses of artificial intelligence. Things like harnessing thousands of drones to attack a site. I think, though, the biggest risk that machine learning poses in general is phishing. That is people stealing your identity, your financial information. You know why, Bob? It's because with machine learning algorithms, you could do that on an unprecedented massive scale. And it would be virtually impossible to determine the location, what country it was being done, much less to identify the perpetrators. So I think as a practical matter, again, I'm informed by having read this 85-page report by this Oxford group that looked at the practical risk as opposed to the risk of the Terminators taking over the world. And I think something like phishing on a massive scale is the one that could most impact the clients of the folks on our call today, ourselves, in terms of the possibility to determine both the country, the location where it's being launched from, these phishing attacks, and to identify the perps.
So I have a question for you, a personal question here. You're the person I've met who's probably most closest to this disruptive technology, and my question to you would be, would you Roche, to a self-driven car stage?
Yes, and I know that they've been working on self-driven cars at Carnegie Mellon since 1989. So again, this is not new novel, but absolutely, yeah.
Okay. And the final question that I have is are we going to have robot companions? What's the outlook for that?
I don't care for robots. I'm partial to human companionship.
Human companions?
Bob. Yeah, with my wife and my two sons and other family. I'm partial. Although I do know that in Japan right now they're exploring using robots as caretakers of seniors because of a lack of a lack of a surplus of caretakers. But I prefer human companionship. So.
Well, this has been a whirlwind, Rick Roche. I really appreciate you spending the time with us. Folks, audience, do we have any more questions here? This has really been a pleasure and have enjoyed our time with you. And I just want to remind everyone that Rick's contact information there, his telephone number, 612-501-1317. That's 612-501-1317. And you can also see below that his email address, and would certainly encourage you reaching out to Rick. Rick has been very generous with his time and sharing his perspectives and expertise. So once again, I want to thank Rick Roche, Managing Director of Little Harbor Advisors, and also the founder of Roche Invest AI LLC. That's Roche Invest AI LLC, and would encourage everyone in the audience to please stay in touch with Rick and reach out to him. Rick, do you have any closing thoughts before we sign off?
I think, you know what, there are, I've laid a number of both challenges and opportunities here. There are lots of things that people can do from the beginner stage to take baby steps, to have intermediate steps or advanced steps. If you wanted some baby steps, I'd recommend find some of these alternative investment data providers and purchase signals from them to see whether or not they work with your portfolio style. If you want a more intermediate stage, learn a programming language. Read Advances in Financial Machine Learning by Marcos Lopez de Prado, or read Machine Learning by Dr. Tom Mitchell from Carnegie Mellon University. That will at least open up your eyes about this. And then finally, if you wanted to be an expert, get yourself on AWS, Amazon Web Services, Google, a platform that has both open libraries of machine learning algorithms and has that computational power to go the full Monty. So there are a number of steps people could take, from taking baby steps to intermediate to the expert level. And I believe that there's a train coming through that tunnel, Bob, and we're a bit too complacent right now in the asset management industry. I say that across the board, self-included, which is one of the reasons I initiated this research effort about 2.5 years ago in the first place. That would be my closing comments.
Well, it's been a real pleasure, and I just want to leave you with one fun fact, at least a fact that I think is kind of fun and I think relevant to this conversation. According to the U.S. Census in 1800, 70% of the U.S. workforce was engaged in agricultural activity. By 1900, that number had dropped to 40%. As of the census of 2000, it was 1.5%. So you can see industries, the way we live, it's very possible for things to be disrupted on a massive scale. And I think that's what you're talking about here. And I guess in many ways, it's not like this is the first time that's happened. Maybe it's going to happen more quickly now, but it's certainly not the first time. I think probably everyone on this call, somewhere along the line, with fishermen and farmers, in our heritage, but not so much today. We're doing other things like we're running or we're involved in technology and so on and so forth. All jobs and careers that didn't exist generations ago. So, Rick Roche, thank you so much, and I know that you'd be willing to advise people on the call on any of these related matters. Correct?
And Bob, thank you for being the moderator and the host today, and I want to thank BJ Bellick as well, too, and everyone from New York Alternative Investment Roundtable who took the time out of their schedule to listen today. Thank you.
It was a real eye-opener. Thank you, Rick Roche.
Okay.
All right, folks, until next time, bye-bye now.